Hi, I'm Greg Hunter. Welcome to USAWatchdog.com. With us, a regular guest that I have on. He wrote this book in 2013. It's The Coming Bond Market Collapse. Of course, I'm giving it away here. Michael Pento. Very popular book. He's still on his website. He's also an economist, a money manager, and he's come on to give us an update about where we are in the economic cycle here. I mean, on one side, we're hearing, unemployment below 4%. On the other side, we're hearing things are slowing down GDP wise. Michael Pento, what are we doing? What's going on? Thanks for being on the show.
Thanks so much for having me back on, Greg. Well, first of all, you have to understand what happened. So we know what the progenitor for the 2008 global financial crisis was. It was debt. Well, Bloomberg just did a study, and the BIS also concurred that global debt has increased to $240 trillion from $170 trillion a decade ago. That's $70 trillion increase in debt, 70 trillion, which is 41%, a 41% increase in the leverage of the globe, okay? An all-time high of 330% of worldwide debt to GDP. Never before happened in history. And if 2008 was a disaster, well, we know what's going to happen now. What happened is central banks took interest rates to 0%, left them there for 8 years. Going up into the crisis, the housing bubble was 1 year for 1%, from 2003 to 2004. And at its apex, $16 trillion worth of global debt had a negative yield. And I wrote a book called The Coming Bond Market Collapse, which you just showed. Everybody should know about that now. Well, it's no longer predictive work. It's happening.
Yes,
the global bond market is in the process of bursting. If you look at the 10-year note in the United States, 10-year Treasury went from 1.3% to almost 3% today. LIBOR, 0.3% to 2.4% LIBOR. So the global bond market is bursting. And what I find most unbelievable, Greg, is that Mr. Powell, the head of the Federal Reserve, saying, and it's viewed by the mainstream financial media, which you are not a part of, and it's viewed by most of Wall Street. People like Mohammed Al-Arian will say that the increase in interest rates, the great deleveraging process has consummated, and central banks can raise interest rates, and they call it a beautiful deleveraging, a beautiful process. That is a lie, and that's why people come to places like Greg Hunter and USA Watchdog to learn the truth. And this is not my data. This is BIS and Bloomberg data. $240 trillion of global debt. The bond bubble is bursting, and I'll tell you something. It's causing problems in emerging markets. This is just one example. So look at Argentina. They went out and actually had the audacity to float. It's actually very intelligent, but it's stupidity on the part of yield-hungry investors. They went out and purchased a 100-year bond in Argentina that's dollar-based. So, I mean, Argentina is a serial defaulter, but since their rate was a little bit higher than what they can get in local currency debt, people piled, oversubscribed into an Argentina 100-year bond. Well, what happens is that the Federal Reserve has raised rates 6 times. They're going to do it another few times this year, or so they say, before the economy implodes, but maybe they'll get a few more in. And Argentina has a choice. They can either allow their currency to plummet, which makes paying this debt back impossible, or they can raise interest rates to defend the value of the currency. Well, guess what? Argentina raised rates to 40%. Greg, this is just one example of the bond market, equity market, currency market chaos that's coming. Not even coming, that's here now. You have to ask yourself, why? Why has the major stock market averages gone nowhere but down all the way into mid-May 2018? Why is the Shanghai Exchange down? Why are the Euro markets down? Why are emerging markets crumbling now? Starting, incipient crumbling. It's because the bond bubble is in the process of bursting. And as that bubble bursts, look for this chaos to metastasize across the globe.
What do you make of Powell coming out, and this was in Zero Hedge, and basically the article said, third world countries, third world nations, you're on your own.
He thinks
emerging markets, you're on your own, basically third world. Emerging markets, you're on your own. Sorry. I mean, it looks like it's an every man for himself type of deal, isn't it? I mean, right now?
Well, when you have record debt and 40% interest rates in Argentina, I mean, debt there is up 40% in the last 10 years. How do you think that's going to fare? I mean, we've had the Thai baht crisis, the Russian debt crisis, we've had LTM crisis, we've had Mexican peso crisis. We've had crises that extend all over the world throughout history, and they're all coming to a confluence now, and probably at a head in October when we have the reverse QE go from 30 billion a month to 50 billion a month. We have $1 trillion plus deficits. The ECB the European Central Bank goes from 30 billion euros a month to 15 billion euros a month in QE, and soon to be zero. So global central banks are going from, 180 billion per month of QE to zero come the end of this year. And while interest rates rise and central banks start pulling back the stimulus, and the private dealers, the ones who front ran central bank bids, then start to front run central bank offers, that's when this thing starts to escalate. And I believe it brings down real estate prices, equity market values, currency chaos, economies, unfortunately, a worldwide depression is coming like we've never seen before, because we have never before had so much debt sit on top of artificially suppressed interest rates, and the hubris and arrogance of central banks to take that away, which finally they're way too late in doing so. They think they can do it with impunity. They're dead wrong. They've always caused a recession. Look, the spread between the 2-year and the 10-year note is now 44 basis points. That's by far the lowest it's ever been since prior to the Great Recession. So we're 2 rate hikes away from inverting the yield curve. 6 months down the road after that, there's a recession. There's nothing the central bank can really do to stop that from happening. I mean, the ECB will barely be out of QE. What are they going to do? Lower interest rates? Is the Bank of Japan going to lower interest rates? They're at zero. The 10-year note in Japan is zero. There's no central bank aid coming in imminently. And that's what I really want to talk about. Listen, unfortunately, I believe I'm 100% correct. We're heading into a global depression. The question is, what are central banks going to do about it this time? The Federal Reserve doesn't have a 5.25% Fed funds rate that they can take to zero. They don't have a balance sheet that's $800 billion. They have a balance sheet that's $4.3 trillion. They can only take back a couple hundred basis points. So the steps that they're going to take after this depression are things that you've probably heard about it. The powers that be, the Illuminati, are pushing things like negative interest rates, and they're pushing things like universal basic income, and they're pushing things like helicopter money. Those are all those things they're probably going to have to go to in an effort to reinflate the asset prices, which will be plunging from record high altitudes after the depression becomes manifest.
This is what you were talking about, what's happening right now, the worldwide synchronized recession. And I got to point out in your book, and I'm not trying to sell you a book because it's been out for 4 or 5 years, although people should buy it because it's no longer a predictive book, as you said. Now, when you open the pages, it's like, this is your roadmap. Here's what's happening. This is what's happening now. I mean, so this is going to get ugly. I mean, factories are going to close. I mean, car sales are way off. General Motors just offered a deal, and I'm a General Motors buyer of cars. I don't buy them all the time, but they just offered the deal of the best deal, and probably the deals would get better, 20% off the sticker price that they just put out. One dealership was offering 25% off the sticker price. That's unheard of. That's outrageous. So I mean, car sales are all way down, way down. and they're heading
right.
lower. So that's just a sign of what you're just talking about, the beginning, the opening app of a worldwide synchronized recession, not just happening here in America, right?
This is one. You're correct. Again,
You're correct.
This is one
I'm
of the,
reading. I'm reading. Oh, incidentally, I'm reading from one of your most recent posts about a
right.
global synchronized slowdown. You're the one that's correct. I'm just reading your stuff. But go ahead.
Well, so, thank you. So, one of the problems that becomes manifest from having interest rates at 0% is that companies become able to survive. They're called zombie companies, by the way. Companies exist by selling debt to pay debt, interest on debt. And the only reason why they're able to do so is because people are starving for yield. Investors are starved for yield. And the number of zombie companies, those companies defined as companies that don't make enough money to pay interest on their outstanding debt. So it's basically a Ponzi scheme. The number of those companies has doubled since 2008. It's close to 20% over here in the United States and indeed
Wow.
in the world. 20% of corporations exist by being zombies, issuing bonds to pay interest on existing bonds.
Oh boy.
What do you think happens to those companies who, by the way, they're small businesses that employ most of the U.S. workforce in aggregate? When interest rates rise, they cannot meet the debt service expenses and they get cut off from the bond market. Investors don't fund these companies. There's massive layoffs, unemployment rates spike, stock markets plunge, economic growth plunges, asset prices plunge, including real estate. Debt goes from, by the way, let's just be honest, we're already over $1 trillion in the deficit. If you add in the fact that the Fed is selling $50 billion a month in October, that makes it $1.8 trillion. In the last recession, deficits increased by over $1 trillion. So you're talking about annual deficits, Greg, that are going to be close to $3 trillion per annum. Annual deficits, that's what it means. Imagine if our annual deficit in the United States jumps to $3 trillion. That's what it's going to do in the next recession, which is not too far away in this very long and extended business cycle. And it's going to happen because the yield curve inverts, as it always does. The Federal Reserve, last 9 out of 9 times, the Fed has raised rates. It sent us into a recession. And by the way, in 1987, I love people tell me, well, the stock market cannot go down because we don't have an inverted yield curve. Is that what happened in 1987? I think we lost 23% of the value of the S&P 500 in one damn day. And the yield curve didn't invert. And it was because interest rates were rising. It was because there was currency chaos extent in the world. It's exactly what we have today. So I run money for a living. I have a very balanced and hedged portfolio. You can't be flying out there 100% long FANG stocks, leverage long. By the way, there's a record amount of margin debt out there too. Off the charts margin debt. So, if you look around the world, if you know the facts, you know the data, you know the condition of the world is the most fragile that it has ever been. Central banks are in the process of destroying the confidence in fiat currencies. The global depression is going to become manifest and metastasize across the globe, probably later on in 2018. And that's when all faith in fiat currencies goes away, if not forever, for a very, very, very long time.
I had Nomi Prince on, best-selling author, but before that, she was a very successful, high-powered Wall Street banker, very high-ranking Wall Street banker. At the end of the interview, I said, well, how does a little guy protect himself? And she starts saying, and I can't believe I'm listening to a former Wall Street banker, and she starts saying, well, you buy gold and silver, physical gold and silver, that's what I'm doing. And that's not as liquid as cash, so you need some cash outside the bank because they close the doors and they're going to close the doors to you. And you need to get out of debt. And I'm thinking, I'm listening to a former Wall Street banker telling people about I bet she has water and baked beans in canned goods too. I mean, what she's describing is something horrible.
You
This
know,
is a
you know,
former. I mean, how bad is this going to be for the guy in the street?
well, government, Wall Street runs, financial markets run on insider information. That's how they're run. And you know who has the most inside information is big banks and governments. And governments like Russia and China, and even JP Morgan, big banks, they're loading up on precious metals.
Yeah,
And it's for a reason, Greg. They know. They know what's going to happen. They're trying to talk down precious metals because they want to get it for themselves at the cheapest price possible. But they know what's going to happen at the other. They understand that balance sheets, corporate balance sheets, consumer balance sheets, government balance sheets, central bank balance sheets are all stretched beyond limits. So they know that this next recession/depression is going to be brutal and protracted. And they know that the faith in fiat currencies is going to be destroyed because they know what central banks are going to have to do. Central banks are going to have to send checks to people that are latent and fallow and unemployed. And that figure is going to have to be inflation adjusted. It's called universal basic income. It's coming. In fact, I was watching Fareed Zakaria on the Global Public Square, GPS. He had an individual called Chris Hughes who wrote a whole book promoting, this person was one of the founders of Facebook. He was promoting universal basic income because even though the market pulled him out of poverty in Appalachia, he has the hubris to believe that the market doesn't work for, I guess, the dumb people, the average schmuck.
Which is communism, universal basic income. That's communism.
Excuse me, it's communism. Is that what you said, communism?
Communism, yes, sir.
It's been, by the way, UBI, they love to have these new words. UBI is another word for, you're so brilliant, Greg. It's a code word for communism. And by the way, I think communism was tried before.
In
Soviet Union and in Cuba, it doesn't work very well. And if you send people money to become unproductive, they become unproductive, even more so. And when you have unproductivity in an economy, money supply tends to soar because you're going to have to inflation adjust this monthly stipend. Plus, the amount of goods and services plummets, so that the money that's in circulation, broad monetary aggregates, will show inflation as measured by money supply is soaring. At the same time, the amount of goods and services available for purchase diminishes. You're talking about runaway inflation from the universal basic income. But that's only one of the things they're going to try. Don't forget, they're going to outlaw the whole idea behind this Bitcoin game is to get an IMF or a Fed coin out there. People just get away from physical currency. You can't take your money out of the bank. Oh, by the way, the money in your bank, now your interest rate is minus some number, minus 10%. And there's nothing you can do about that. Zero. You can either have your money in the bank or spend it using a Fed coin, which, by the way, the government will give you as part of your universal basic income. You'll get an electronic notification in the mail of how much you have and how much you're losing. So you better go out there and spend it. So the money supply grows, velocity increases, and guess what happens? Runaway inflation. That's all the things they have to do to get asset prices back up. Because the stock market right now, the value of equities is 150% of the underlying GDP. That has never before happened. I know I mentioned that on your show a lot, but that's where it is. It only happened before. One time was a slightly lower in March of 2000, and we know that the NASDAQ lost 80-some% of its value. So that's how overvalued the stock market is. We know real estate prices are record valuations, and we also know, of course, the international bond bubble is beyond precedent. So you're going to be losing money in your bonds, in your equities, in your real estate. They're going to be in a panic to get asset prices going, and they're going to use UBI. They're going to ban cash. They're going to make interest rates negative, and they're going to also have the helicopter money, which is part of UBI. So helicopter money is a form of universal basic income. And that's why they're buying gold and silver now and platinum.
And how much is it going up? How much do you think? I mean, right now you can go to a coin store and you can actually buy silver at, I don't believe it's $18 plus, $16 with a commission. I mean, $19 that includes the commission. You can buy gold at 13, 70 or 80 with including the commission. I mean, per coin, that's just what it works out, commission on coins. But you can buy it relatively cheap, and you can buy it, yet the bar market is tight as heck, according to people like Rob Kirby. What do you think is going to go with, what do you think the prices are going to go for gold and silver?
Well, I think once the recession becomes manifest and the central bank has to admit, and this is an admission that they're going to have to be dragged into, Greg. This is not an easy admission. Right now, the central bank has got a little swagger. They're out there saying, hey, we can raise interest rates and we can do reverse QE. And the economy is going to be fine, and we don't care about emerging markets, and we don't care about the dollar, and we don't care about the stock market. So what's going to happen is, and by the way, I think the central bank, our Federal Reserve, has never been more hawkish. So our central bank has never before, they're raising interest rates at every meeting with a press conference. So that's pretty aggressive. It's fairly aggressive. They've gone more aggressive on that front, but this is pretty aggressive. Every meeting that there's a press conference, so 4 times a year, they're hiking rates at the same time that they're destroying $30 billion right now per month of money supply. So the Fed's saying, hey, I've got a bond that's matured, Mr. Treasury, I need money. Treasury doesn't have any money. They go out and sell a bond to the public at a market price. The public pays the Treasury, right? And the Treasury pays it to the Fed. And the Fed takes that money and burns it. Those reserves, they're burning reserves. So they're doing that to the tune of $600 billion a year at an annual pace come October. At the same time, they're supposedly raising interest rates on the top of a massive bond bubble, on top of record asset prices, on top of record debt. And how the heck is that going to end well? But when it implodes in their face, as it has always done in the past, asset prices crumble. That's when, let's just say, the stock market has to go down 20, 25, 30% before we get the Fed to start panicking. And they panic. And the first thing they're going to have to do is say, we're going to stop selling our assets, our longer dated treasuries and mortgage-backed securities. Then as the stock market continues to crumble, they're going to put on hold any future rate hikes. But that's not going to solve the problem. We'll already be in the middle of a recession in the United States. And markets drop 50% plus in recessions. So to get us out of that, to get bonds back in a bid for bonds and a bid back in real estate and a bid back in the stock market, they're going to go to UBI and ZIRP and NERP and helicopter money. And that's why you need physical possession of precious metals. Now, we're comparatively speaking, they're going to go on sale. So once the recession starts, and I think it's going to start later this year, and I think it becomes full-blown manifest in 2019 when we have all these things that I just talked about in place, that's when I think gold goes to all-time nominal highs and silver goes to $40 an ounce.
And do you think that it'll get so bad that people will just stop selling it? There'll just be no bid. There'll be days where we have limit up, and well, you go to your local coin shop, and they go, yeah, sorry, we're going to kind of not sell for a while. Because they'll play the market with their inventory, right? I mean,
first of all, you're going to get shut out. All the people that have been piled into paper gold assets, which is not backed by anything, really. Those people are going to understand they don't have their gold. They're going to convert their paper gold into real gold and take it in their possession. So there's going to be a run on gold like we've never seen before, a super spike in the precious metals. That makes the run up from 2000 to 2008 look like nothing. From 2008 to 2013, 14 look like nothing. So this is unprecedented times coming, and you should take physical. This is how you should own your gold. You should need to take primarily physical possession of your gold.
And you like silver too, though. But you like silver too.
I like gold, and I like silver, and I like platinum. I most especially like gold though here, because silver has a industrial component, and if I think we're going into a global depression, I think the gold-silver ratio is going to stay very wide, as it is today.
So in other words, gold will go up to 3,000, and silver may go up to 40, and it still may be 80 to 1.
Right. Exactly.
Okay.
Perfect, exactly.
Okay. All right.
Exactly.
Fair enough.
So this is all going to happen, and it's when I used to come on your program, it was I guess I started maybe 2013 or 14. It was all prediction, and it sounded hyperbolic, and I sounded like a Cassandra. This is happening now. The bond bubble is bursting. Ask yourself why the stock market in the middle of May, all the major averages are down when we have record earnings. These record earnings exist because of a one-time event which was a one-time deficit-funded tax cut. We have peak margins in the United States. and we have peak earnings on top of peak global growth. That is not the time you want to be leveraged long on margin in the stock market like everybody else. You have to have a hedged portfolio that's actively managed. And that is what I do for my clients.
And I just want to get into this when you talk about the bond market bubble bursting, so normal people, dummies like me, can understand. It's debt destruction. I mean, it's like the Puerto Rican bond, $74 billion. They go, sorry, we can't pay you. I mean, that's what's going to happen. These bonds are either going to be completely defaulted on, or they're going to give you a haircut, and they're going to pay you a lot less. I mean, isn't that what you're talking about? Debt destruction. All these bonds are going to get hammered, right?
Greg, you're 100% correct. So there's two ways to destroy this debt, and that's why I have a portfolio that's inflation deflation. Number one, first of all, the bond bubble in the incipient stages that it's in right now is bursting, just meaning that the price is going down and the yields are going higher. That's all it means right now. But eventually what you're talking about is going to come to fruition, meaning that in the case of Argentina, which duped ignorant investors who are absolutely clamoring for yield to invest in 100-year bonds that are backed in dollars, which Argentina cannot repay. So they're going to explicitly default on that debt. But before we explicitly default, and especially in the United States, you know, we have the world's reserve currency, and an explicit default, which is a restructuring, basically saying, you know, we used to owe you a par on a bond, but it's going to be 50% of that or some number. We are now going to default on this debt. But before the world's reserve currency in the largest economy and the largest creditor nation on earth defaults on its bonds explicitly, it will seek to do so through massive, humongous, gigantic debt monetization. That is what I believe. I believe, and I believe it because they've said it, that Mr. Powell said, as long as the stock market doesn't collapse, we will continue to raise interest rates. What I glean from that, you can surmise that means if asset prices collapse, we will once again massively expand our balance sheet. Not to just 4 trillion, to 10 trillion, 15 trillion. And excuse me. And you blow up the monetary base and the broader aggregates. I come up with 6,000. You know, if you do a measurement of the money supply to ounces of gold, I come up with $6,000 an ounce in gold. But the money supply, both the monetary base and the broader aggregates, are going to explode in the aftermath of the next recession, depression. So, you know, you're talking about gold. I know Mr. Rickards is a friend of mine. He predicted $10,000 an ounce. That could be just for starters once we start getting this intractable inflation going. I mean, the Fed wants 2% inflation, as they think that that's nirvana, and so does the ECB, and so does the Bank of Japan. 2%, you know, they had trouble beating 2% because they don't measure asset prices. They just measure the completely manipulated core PCE. They don't even look at their own CPI measurements from the BLS. But 2%, that's going to have a zero after it by the time they're done.
20%. And you think that the U.S., I mean, before, when you say monetization, you know, we're going to pay you back in confetti. You know, here's your money. Here's $10. That'll buy you a piece of bubble gum. I mean, that's what you're talking about happening.
Well, that's what.
And then they're going to say, "Hey, you know what? We're sorry. Those treasuries." You're saying they're going to ultimately default in two ways: in inflation, and then they'll have an outright default in treasuries at some point. Is that what you're saying?
Greg, that's what I'm looking at history. That's how countries default. First, they try to print because they have the power of the printing press. You know, Argentina first, and not just them. I'm talking about Zimbabwe. I'm talking about the Hungarian Pengo and Weimar Germany. First, you try to hyperinflate your way out of it, and when that doesn't work, you say, "Hey, guess what? Our currency and our bonds, they no longer exist. Sorry. So here's our new currency, and here's our new debt. Sorry." Yeah. That's it. By the way, how many fiat currencies can you name that have survived?
That'd be zero.
That'd be zero. Well, why is it different this time? It's not. And these are, you know, you had a condition where small, historically speaking, relatively small banana republics would default on their debt. completely after they tried hyperinflation. We have that kind of function, that syndrome, across the globe right now, which is massive debt that we can never repay. So the same math that led to hyperinflation in other nations, some of them not banana republics. I don't consider Hungary and Germany banana republic. Same functionality is going to apply to the world's reserve currency. That's what's coming.
With that, I'll leave it. There's no wonder why rich people are buying gold and silver and platinum. There's no wonder why they're buying physical metal. No wonder. I mean, they know what's coming.
The insiders know, and now that you listen to Greg Hunter, you know too.
Well, I think people should listen to you, Michael Pento. I'm just the conduit. You're the guy with the brains in this operation. But I will thank you, Michael Pento. Pento Portfolio Strategies. I'll put the links in before and after the interview. Michael Pento, thanks for coming on and giving us a massive update. I know it's not good news, but to be forewarned is to be forearmed. And thank you so much for coming on USAWatchdog.com.
Always a pleasure, Greg.